Good Friday, everybody. Happy to be here with you today, trading a smaller account. I'm Connie Hill. Barb is down in Houston today for one of our workshop events, so I am filling in for her. But I'm glad to see so many of these friendly faces that we get to see throughout the week. I'm glad you've joined me here. I hope you're following me on X. I'm on Connie Hill CS, and I'll post educational content, different things that I see in the market. Yesterday was a busy day. Today, getting to be another busy day. Now, it is the time of the year when we have a lot of parties, whether it's a Christmas party, Kwanzaa, Hanukkah, New Year's Eve, just getting together with family and friends. It's all about the parties, isn't it? So sometimes you might want to be fashionably late to the party, but with trading, we don't want you to be late to the party, right? You want to be on time to the party, which means nailing an entry. So we're going to really focus on those entries today and maybe what you might be able to consider so that you are on time to the trade party. I am joined in the chat by Mike Fairborn. Mike, thanks for being here today. He's been trading the markets for years. As you have questions, go ahead, chat those questions, and I'll keep my eye on the chat. Mike will as well. Those of you that are listening on the recording, when you have a question, put your question in the comments section on YouTube. We go back and answer those throughout the day so you get your questions answered quickly as well. All right, let's go through our disclosures, and I've got a full agenda for us here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and educational purposes only. Don't consider it a recommendation. We will be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. Hope you're practicing in it, and feel free to take any example trades we do here today and do them in your Paper Money account as example trades. Past performance is no guarantee of future results. Now, typically what we'll do is just take a quick look at the market. We're going to be looking at several example trades where we're going to be focusing on different types of entries so you can be on time to your party. And I'm going to follow up on a trade we did yesterday in my Selecting an Option Strategies class. I know some of you attend that class. You might be interested in that. We'll kind of wrap up seeing what happened with those trades. All right, let's get busy. Now, if you, I was going to say, if you have identified your favorite entry type, I want you to chat it into me here, okay? What is your favorite entry type? As you chat that in, we're going to take a look about the rules of this class. Now, this is the trading a smaller account, which means we're really focused on trades where you can have a small position to help build your account. So we started with $20,000. At the beginning of the year, I know Barb has been tracking that, and that has improved dramatically over the past calendar year. Max position size that we put into any position is $5,000, and usually we don't even get that high. Max trade risk, $400 to $500. We'll be using that today. That means we're going to be focusing on shorter to intermediate term trades. We'll look at both bullish and bearish stocks. We could go either way. The focus on certain strategies will be, if we're looking at bullish type trades, long stock calls, short puts, buy right covered calls, short verticals, long call verticals. A lot of option strategies make it easier to put in a small amount of money and capital to commit to a trade. And that's why Barb's really been focused on those. Now, there could be some bearish opportunities, long puts, long put verticals, short call verticals. Sometimes we'll get into calendars and iron condors, but we're really stressing a lot of those spread strategies. All right, now I'm going to look and see if anybody put down what their favorite entry was, and I'm not really seeing that, but okay. You don't have to put in your favorite entry if you don't want. Oh, okay, here they start coming in. Here's Kevin, likes like a hold at support. Excellent, Kevin. That's one of the signals we're going to look at here today. Let's jump over to our Paper Money account. Just kind of see what's going on in the S&P today. Now, right now, it's down a little bit, isn't it? We have been trading in kind of a sideways area here over the last, I forgot, this isn't working so good. My drawing tool, that is. We've been going kind of sideways here though, right? We hit a higher high back in November. pulled back to the 6,500, very strong support area. Those of you that have been in my classes, we've talked about maybe this is a head and shoulders forming, right? The shoulder pattern here, head at the top, second shoulder forming here. But it's not complete. It's not a completed pattern. And it wouldn't be complete until it came back down to the 6,500 area and broke down below. So overall, the 10-day moving average is up. The 30-day red moving average is kind of flattening out here a little bit, although it has been in an upward motion. So it looks like, is the market getting a little tired? Is that what we're starting to see here, that it's going a little bit sideways? I think we've also seen a little bit of a shift from certain industry groups and sectors that have been strong to other ones that haven't been as strong, that are now getting a lot of hits. If you follow me on my early morning mover scan that I like to post about most every day, you'll notice that the sectors have changed. Yesterday, it was industrials and materials that really were the bulk of the results in that scan. All right. Greg likes any pullbacks. Wild Goose likes flags. Reggie says BF. I'm going to say that's probably not for best friend, but we're going to go with bull flags on that one. Could be bear flag. Okay. All right. You've identified maybe a signal that you look for, that you're like, yeah, when I see this signal, I'm going to be excited about it. Doesn't mean it's going to go anywhere, but many times it might. So we're trying to identify what those tend to be. Kelly, you like to use those whole moving averages. James Boyd uses. I had those up here earlier today, but switched over to the 1030. Okay, so some of you are using moving averages, and when it breaks above the 10 and 20, whether it's a simple moving average or whole moving average, you're saying now is the time to get in. All right, let's take a look at our first opportunity here today. And if you have questions, like I said, Mike's here. I'm here to help answer what your questions might be. All right. As we look at Merck here, sideways for a little bit, then looks like maybe November started to take off really nicely, has pulled back here a little bit, but it's still basically showing us an upward trend, isn't it? So on this kind of a pullback, we might say, all right, when it's bouncing, we get a bounce, or we get off a moving average or a support level we identify, or maybe it's bouncing off a moving average or a diagonal support, we're interested in those. If we see a close above the high of the low day, we might be really interested in that, right? Close above the high of the low day, I kind of have listed out those couple of entries here, because some of you might go, oh, I think I know a call, but I might not. All right, let's show you what it looks like, because we were seeing one earlier today. This little pullback, 2 to 5 days is ideal. This one went a little bit longer. This pullback is the low, or this is the low in the pullback, I should say, this red candle here. And the high that day is 99.85. Okay. This day, it didn't go lower, so this stays the same, low day. This day, yesterday, oh man, it looked like it was bouncing up, didn't it? But it did not have a close above the high of the low day. Now, earlier today, this was trading above the high of the low day, and some traders like that. They'll say, okay, if I see that movement above the high of the low day, I'm not going to wait till the end of the day and see if it closes there, although you could. Some traders might say, I'm going to get it on a trade above the high of the low day. All right. So this could be a signal for some folks. Let's go see what the options look like here. Would this be on time to the party? Yeah, this would be on time to the party. We're going to do, in this case, we're going to do a short put vertical here. Oops, let's clear some things out. And on Merck, I was looking at some of these weeklies to see if they had some decent activity in them. And, I didn't write down which ones I was going to use here. I think we're going to use the January 16s. I'm just going to check the January 9s here. Not a ton of open interest. January 2. January 2 actually might not be too bad. But I don't nope, we're not going to go with those. We could, actually. 20 to 40 days of time is what we typically like to sell. We've got single dollar increments here. That helps somebody that's like, maybe I can only do 1 or 2 contracts, right? If you have single strike increments, it makes it a lot easier to identify those trades. And this is the one I had targeted. It was the 98.97. This 98 is a 38 delta. The stock is pulled back a little bit. We might get away with a 97.96. So let's start there. See if we can do 97.96. That one has a delta of 32, and it has a 66% chance of expiring out of the money. So it's a higher probability trade. And if we are willing to, well, this has given us a 32-cent credit if we're willing to risk 68 cents or $68 is how it will work out on this one. Let's go ahead and just kind of lock that for a moment. All right. On this, if we can risk $500 on this trade, we could actually do a few contracts here. If you're in a smaller account, you can only risk $200 or $300 a trade. These are kind of the strike prices and the kind of trade that might suit you. Okay, just because you're able to get into it, and it is a higher probability trade. Now, in this scenario, the implied volatility is not super high. Sometimes people will look for higher implied volatility here and base their decision on that. In this particular case, it's just kind of average implied volatility baked in, but not super high that we're trying to take advantage of. Okay. Let's go back here to the right ones, though. The ones we picked. Let me just scroll back up there to the January 2s. Yeah, 65% here. Okay, let's pull out our calculator. We can risk $500 on this trade. Our max theoretical loss is going to be the difference in the strike prices, a whole buck minus 32 cents, right? That gets us to our 78 cents. Is that right? Let me make sure of that. 100 minus 0.32. Yeah. Oh, I did the wrong number there. Let me clear that out. I might have had something extra in there. 1.0 minus 0.32. Yeah, it gives us 68 cents. So 68 bucks is what we could risk. So 500 divided by 68 going to give us 7 contracts. So that's what I identified. Yeah, we could do 7 contracts here. If your account can only do 2, just do 2. Don't worry about it. If we can do 5, do 5. Don't worry about it. Okay. That's how we build those stronger accounts, is by seeing what we can do, not risking more than what we should do. And sometimes we're looking for those higher probability trades, but it could be something else. So Wild Goose says, so the max risk is equal to the credit received. Actually, that's the max gain, right? We're not going to make, if on this particular trade, if it goes to options expiration, we're going to not make more than $32. Okay, that is our max gain. So 1 minus 32 is 68. That's going to be our max theoretical loss on this particular trade. Okay, so you want to make sure, yep, it's a little bit different when we're figuring out long verticals than short verticals. But for short verticals, that's how that works. Okay, so we can do our 7 contracts. And sometimes what's nice that some traders like to do is say, you know, if I get a chunk of this, if I get a decent chunk of this, don't hold out for every penny. Don't try to squish out all of the toothpaste out of the tube for a trade, right? I do that with my real toothpaste, but for a trade, man, I might not necessarily want to get every single bit. I might say, hey, we've got the most out of this tube of toothpaste. We've got a good chunk out of this trade. Let's take it and move on. What's a good chunk? Well, you get to decide, right? A good chunk to you is going to be different. I've asked this question in a lot of my classes. Some people say, I take it at 50%. Other people are like, 60 to 70% I'm happy with, right? Some people hold out for a little bit longer than that, right? So you decide where your comfort zone is. On this one, let's go for 75%. If we get 75%, only 25% is going to be left. So let's take 0.25 times our credit of 32. That says go buy it back when it's 8 cents. So let's create an opposite order here. We're going to say go buy this trade back. If it gets down to 8 cents or better, buy us back. We'll be happy to skip out, move on to another trade. All right. That is going to be the first trade with our first hold entry type that we're looking for here. Let's see. Paul says, on the January 16 monthlies, there are only $5 increment strikes, but the January 2s have a $1 strike. Will the January 16s get the $1 strikes later? How does that work? Fantastic question, Paul. Some stocks trade a lot of activity. This stock here is traded over 5 million on the shares today. That leads us to typically stocks that have greater liquidity. Stocks that have greater liquidity are likely to have those $1 strike increments built into them eventually. Okay, now let's just look at the December 19s here. What you're going to notice here is on the 100, we'll just look at the calls here. A 100 call has 20,000 contracts. 95 call, it has 8,000 contracts. And these other ones, they have some decent open interest, but it's not as big. So they start out, in this particular case with Merck, they'll start out with the 5-minute or the $5 increments. Sometimes if it's a higher price stock, it might be $10. Okay. And then maybe about 3 weeks out, they'll put on those weeklies, right? Where right now, if you can see how far out the weeklies go, the weeklies actually go out here to 28 days right now. And so on Monday, they'll put out some that are 7 days beyond the 28, although we'll have 2 days over the weekend that will go by. Okay. So that's what happens. Do all of them go to dollars? No, not all of them. Just those that have a lot of liquidity, that there's a lot of trading activity, those are going to be the ones that people, or that they'll put those single dollar increments on. Yeah. Very good. Now, CB says, 10% volatility on the front week over the long weekend might be tempting. And that could be tempting. Yeah, I see what you're saying here. You're saying these December 12ths, they expire today. They do have a ton of volatility priced in there, but look how small it is right now, right? There's really not a lot left in that trade. And that's why, it's sometimes it's better to take a profit and move on, because it's really hard to basically eke out all those pennies. Yeah, it can be difficult. Very good. Did I explain what the note was there? CB says, can you explain the note types? The note typed, I don't know if I've typed a note. I think maybe maybe you're referring to my hold, where I was saying I've got that typed out on my scratch pad, a close above the high of the low day. Let me do it a little bit more detailed, okay? When a stock is in an uptrend, sometimes we'll say, oh, let's see if it'll pull back and give me a better entry. So we let the stock pull back and we look for the bounce. And then we say, well, what's a good enough bounce, right? And some people will use a close above the high of the low day. Now, this is only on an upward trending stock. So we can see, yeah, clearly the stock is upward trending, and we see it's had a pullback. And in this pullback, we look for which day it went the lowest. So more recently here, this day actually was on the 9th, which was Tuesday, is the day it went the lowest. So we call that the low day. And then we have, some candles here. We look for it to close above the high of the low day, which that high was 99.85. It didn't close above it here. We can just visually see that. Didn't close above it yesterday. We can visually see that. And these days didn't go lower, so the low day didn't change. And so what we're seeing now, earlier today, it traded above it when I identified this and said, yeah, we're going to go ahead and do it for a trade. Technically, it's not closing above it right now. It's not sitting at it, right? It's at 99.47. To do an actual close above the high of the low day, we'd have to wait to the end of the market, and we look for it to close above the 99.85. So now is just a trade above the high of the low day. Hopefully that makes sense. Okay. Oh, you were noting. Oh, okay. Very good. You were looking for, let's see, a couple questions here. Let's answer them up. David likes the dollar wide strikes. Wild Goose says you meant the 32, 1,000 minus 32. Okay, just give me some information in there. And really, CB was looking at the market maker move on the chart. You were looking at that. Oh, you picked up on something here. It's actually off our screen, isn't it? Let me come back here. I don't have it in my studies right now. Let's go to another trade, and I'll circle back to what is the market maker move on the chart. Maybe this is what you're referencing, that piece of information. Let's do it on a different trade. Merck doesn't have it. Adobe, that we're going to look at next, doesn't have it. Now, in a smaller account, sometimes you get this vision that you're like, oh, I can only work with low price stocks. Is that really, truly the case? Can you only work with low price stocks? Adobe's $358. It's an expensive stock. So while you might not necessarily say, well, I can't really buy very many shares there, we can utilize the options, right? Lower cost of capital to enter into a trade. What have we got going on here? Adobe's been weak. Some of the technology stocks really have pulled back. They've been weak. It was down here having some support at 330-ish or so, went even a little bit lower. And then it kind of ran up and it formed a higher high. So we're like, oh, is it going to form a higher low? So it runs up here, it forms a higher high, goes a little bit sideways in a flag, makes a higher low. How do we know it's higher? Because today it bounced up. And so we can definitively say, all right, this was the next, that was the first higher low in this potential reversal of trend. It's early on. Might be a little aggressive for some of you. If you're like, I don't know, maybe I want it to be above the 50 for a long time. This is a 30. It's only been above the 30 for a short time, but it is above our 10-period moving average, which really tracks shorter term trends. So on this, we actually have a flag breakout. We see the sharp vertical rise up. We see the short consolidation here. This looks like it went on for about 4 days. Like I said, 2 to 5 is ideal. This one did 4. We'll take 4. And then we look for the breakout. And some traders like to get in on that breakout day. Now, it was a little bit higher today, and it is pulling back. So some traders might go, well, let me see if it pulls back. Let me see if it still really is truly above that flag consolidation at the close of the day. Because we're not going to be together at the close of the day, we just are going to have to take action right now. All right. So it's not I don't call it a fleeg. Ricebird says a fleeg. Yeah, Barb kind of says fleeg, but to me, it's a flag. All right. It's just got to be a flag. All right. Wild Goose, I'll come back to your answer as we do this Adobe trade here. Okay. Is this on time to the party? Yes, we are seeing it when it breaks out. It's nice to see things kind of early on versus it making the move Wednesday and us kind of seeing it Friday morning, right? It's nice to see when it happens. So we're going to be on time to this bull flag breakout. Let's go to our trade tab, see what Adobe has going on. Now on Adobe, a pretty liquid stock, over 3 million shares traded today, even though it's an expensive stock. We're going to use the January 16 options. It too has weeklies, but they're not super liquid. Okay, so I'm not going to drag you through those. We're just going to jump down to the January 16s because look at this open interest. Doesn't that just make you smile? You see lots of contracts, like 3,000 contracts, 800 contracts, 2,500 contracts. Awesome. That's what we love to see is a lot of contracts trading hands. It makes it easier to get in and out of. Typically means a narrower bid-ask spread, right? Many times, let's see what we're looking to do on this one. This one as well, we could go either way on this one. We could do a short put vertical. we could do a long haul vertical. When we have $5 increments on these stocks, sometimes we can only do one particular trade. Okay. If we're doing a short put vertical, we might look at the 345, 340, because this has a 31 delta, gives it a 60% probability of expiring out of the money. We can even entertain this. Well, I was looking actually at 345, which is more, that's 66%. I dropped a line, sorry guys. I was looking at the 345 here. Let's sell this vertical. We'll put it up for our max theoretical gain of about $1.55. Let's go ahead and lock that in place so we can just keep that number from dancing around. All right. $5 wide spread. What would be our risk on this? $5 minus the 155. That's going to give us 385. That's our max theoretical loss. So in this particular scenario, we can do one contract. And Wild Goose was saying, could you run through those numbers again? I think that's what you were looking for there, Wild Goose. Can you explain how to calculate the percentage of return versus percent risk on trades? Yeah, it's kind of a balancing act, Wild Goose. In this one, let's run the numbers, okay? If we are willing to risk 345, I put 385 here, I'm sorry, this is 345. $5 minus 155 is 345. And so we want to take our max theoretical gain. What's the most at options expiration we can get out of this? That is going to be $1.55. All right. So 155. We're going to divide that by our max theoretical loss of 3.45. 5 minus 155. All right. And that's going to give us a number. That number, in this case, is 44%. This at options expiration would give us, if things went perfectly and expired out of the money and we didn't buy it back, we're looking at a 44% return. Now, that's actually, I'm going to say decent. We might be able to get something that is acceptable to other traders, even going a little further out. If we did 340, 335 with a 27 delta. But this particular trade has a 64% probability of this option that we're selling to expire out of the money. And many times, you don't have to structure it this way, but many times traders will structure these short put verticals as higher probability trades, meaning it's more likely to go in our favor, 64%, than not go in our favor. What would that be? 34%, right? So it's like, okay, not quite 2/3, right? That would be 66%. And so you're kind of weighing that. What feels more comfortable to you? Does the higher probability of success more comfortable to you? Or are you comfortable with 64% and I'm going to say a healthy 44% return? Because you're asking, let's just do it. Let's make this a blast all. Let's make this a sell vertical. We'll go one more strike out of the money, a little bit further, okay? Nope. Delete that. 340, 335 is really what I want. There we go. All right. And so it's dancing around here a little bit, $1.27, $1.25, something in that range. Let's go ahead and lock it down, okay? In this scenario, we're not bringing in as big of a credit. We're only bringing in 127 per contract. The probability that this option, the 340, is going to expire out of the money is 70%. So it's up 5% higher than the other one. So kind of over to that side, and you might say, well, what's our return? Okay, what's our return on this one? Let's clear this out. So we'd take $5 minus 127. It's going to give us 373. 373 is our max theoretical loss. So yeah, we have more to gain than what we have to lose. but we have a high probability that the trade would go our way. Okay, so you're balancing that a little bit. Let me just write down this 373, and let's see what percent return it gives us there. So if we take our max gain, 127, divide that by 3.73, that's a 34% return. So some of you might be more comfortable there. You might go, I'm willing to sacrifice a little bit less return on the trade for a higher probability. Okay. Certainly, you kind of find where your comfort zone is, right? And a great way to do it is to do practice trades. Do them in your paper account. See how they work out. See if you are typically being able to close them early and get out early, or if it maybe goes your way a lot or goes your way not a lot, depending on what you choose, right? So you can feel comfortable saying, these are kind of the rules I want to put in place for my trades. It's not a right or wrong. It's more a comfort zone. Okay, so Sharon says, she likes the 340, 335 better. You like the second one better. John wonders if we're too close to earnings. John, let's look real quick. They just had their earnings 2 days ago. They announced their earnings. They got a reaction to their earnings yesterday. Okay, so earnings is out of the way. The news is out. Looks like it's moving in a forward direction here as far as bullishness goes. Ooh, I am seeing a survey out in the chat. Oh my goodness. You guys know from time to time, well, if you're here a lot, which many I recognize are here a lot, but we always have new people joining us. Sometimes we'll put a survey out there. I don't control it, neither does Mike. Somebody with greater powers than us control that. But we like to see what your thoughts are about this particular session. So it's super easy. 2 questions. You just fill in the radio button on a scale of 1 to 10. What you think? Plop, plop. You're done if you want to be. There's also a place to respond to a couple of questions about what you would like to see. And given this is not my class all the time, it's Barb's class, if there's something you would want me to pass on to her, feel free to use that space to communicate that information. I'll share that with Barb. And what might some of those things be? Well, I'm doing X kind of trade, and this is the part I'm struggling with. I'm missing the entries. I'm not taking profits. I'm not doing whatever, or I'm struggling with whatever. Communicate that, and I'll send that on to Barb. And I like to answer those kind of questions in my sessions. Okay? Very good. We'll remind you at the end that the survey is there. If you want, just click it now, put it in the background, wait till you're ready to go to fill it out. Okay, because Eva, because of you, or not Eva, it was, who liked this one better? Sharon liked this one better. Sharon, because you spoke up, we're gonna go with the one that's a little further out of the money, little higher probability of success. We can still only do one contract, okay? We don't wanna risk more than 400 to 500. This one would be risking around 373. So we're going to delete the top trade, and we're just going to stick with that trade. Let's do a first trigger sequential. And again, let's go buy it back when we get a chunk of it, right? We're not going to hold out for every single little last penny. If you do that a few times and you get burned, like some news comes out you weren't expecting, and the option expires the next day, and you're still holding on because you're thinking, I don't want to close it early. I don't want to give back 3 cents. I don't want to give back 10 cents or whatever it is, right? If you get burned on that a couple of times, you're like, oh, I maybe don't want to go that way. But you still could, right? Sometimes there's going to be situations where you're like, it's never going to move there. I shouldn't say never. We don't know. But it's up to you to choose that. All right. So if we can get our chunk of our 127, again, let's go 70% this time. We would have 30% less. That says go buy this back at 38 cents. So we're leaving a little tube, a little bit of toothpaste in the tube. We're not going to chew it out. We're not going to squish it all out, but we're going to enjoy what we got and move on, set up new trades. Sometimes when you're waiting to bleed out these last few pennies, you have more at risk than what you have to gain, right? Maybe you've captured a good chunk of the gain, but you're risking that big chunk for the 10 cents that's remaining, or in this case, would be 38 cents. So that's why we're going to take that approach. Again, just one contract. We're going to hit confirm and send. We're going to send it on its way. All right. We're going to take an aside here for a moment. I hope all of you have become subscribers to our Trader Talks channel. Click on the logo in the bottom right-hand corner that's blue. Looks like YouTube, but in a blue icon. You click that, it says subscribe, and then you can subscribe. When you do that, it makes it so much easier for you to find our content. And let me find my window that has my YouTube. I'm actually just going to go back here, and I'm going to go to our YouTube's channel. When you're in it, this is what it looks like. You get to see Mike's handsome face there. Some of you know JB, Cameron, Barb, and it shows you what's going on. So right now, trading in smaller accounts going on, right? After our class, top of the hour, we're going to have advanced trading or charting techniques with Cameron May. He'll be kicking off that class right at the top of the hour. So it's easy to kind of follow along what is going to be taught when, and you get an idea of what classes you might be interested in, okay? And then if you wanted to go back to Barb's classes for this account, as trading a smaller account, because it goes twice a week, go to the playlist, go down and find Barb's class, and you can go back and follow that playlist. So it's just a handy way to find our content instead of messing around, just searching. You can also, if there's a topic you want, say you're interested in covered calls. Let's go covered calls. Type it in. Let's see who taught covered calls recently. Oh, look, Cameron did. Right here. This one was just 2 days ago we taught about covered calls. Okay, so it just helps you find it. All right. Let's go back to our paper money here. And let me answer the question about the market maker move. I'm trying to think. Today's Friday, so we probably already had stocks that announced earnings. We'll have some earnings coming up next week. But let's just maybe use Adobe since it was in here. Okay. Somebody's asking about this little thing on my chart. I'll share it with you. It's a script. Scripts are only, or I should say, are not guaranteed as to accuracy or timing. You always have to know that. They're going to change. And this particular little script lets us see what the market maker has priced into the options for some news event. A lot of times that could be earnings. It could be a drug, we find out from the FDA if a certain drug did well in its trial or not. If a lawsuit was settled and it's coming up and we're like, okay, company said we're going to find out on Tuesday what happened with that lawsuit. Those are the kind of events that implied volatility is priced into the options. And so what you're going to see, I hope you can follow my mouse. Up here, it says plus or minus 3.618. Right now, that is the market maker move. And what that's implying is a $3.60 move up or down for the news event that's going to take place. Now, honestly, it already happened. So I'm not really sure about this number here because they had their earnings. They announced it Wednesday night. Okay, so the news broke, implied volatility came crushing out. But this little indicator, and I'll put that study on my chart. I called mine MMM on chart, market maker move on the chart. And it shows you what is being priced in there. And so right now it's saying $3.60 for about a 1% move. And then it shows you visually on the chart what it looks like. So if stocks coming into earnings or big news event, then you can see those lines and it can help you identify maybe how you might structure a trade. Okay, hopefully that helps there. Kurjar. All right, very good. All right, some of you might not be ready for scripts. If you're not, don't worry about it. Okay, some of you that are, you're like, oh, I know how to use that. You're going to go to setup, open shared item. You can put that little URL in there. This is going to paste more than that. That's going to paste my verbiage there. So you would get rid of all this verbiage, right? You'd get rid of all this. Just start with the exclamation point. If you're looking at this on the recording, pause it so you can write down what that is. All right. I want to take a quick moment and show you something that happened on a trade that we did in our class yesterday. Because they had earnings coming out, they had a big market maker move expected. It was Lululemon, your yoga pants distributor. Okay, so what was going on with Lulu? Had a little bit sideways, but there was a big market maker move priced in there. I want to say it was above 10% yesterday. It was looking for a really big move. Now the implied volatility is crushed out. It's not as big of a move expected, right? Because the news is out, but it moved really pretty big for us today. So right now it's up about 9.5%. So last night they announced earnings. Let's go to a 1-day, 1-minute chart here. Last night they closed here where it's black. The extended hours information is where it's shaded in gray. So the news came out, boom, it popped, it dropped, it popped again. It was kind of a little bit all over the place before stabilizing. Then this morning before the market opened, it was kind of staying up in this 205, 204-ish area. Okay. And the trades we put on were speculative. Nobody knows what the earnings are going to be. I don't know. Mike doesn't know. We would love to know in advance, but we all get to find out together, right? So the earnings came out and they did well. Well, what kind of trades did we structure there? And we will revisit this again in our trading, selecting an option strategies class. Okay. So we put on 2 trades, a safer, and I'm going to take that back. It's not safe. No trades are safe. A more conservative trade and a more aggressive trade. Okay, the more conservative trade was the short put vertical. We wanted the stock to stay above our short strike of 175. So sorry, guys. Those were some vicious chews. All right. We collected $1.70 in our account, and the stock moved dramatically, right? It's up there at 204 right now. And so pretty much we're able to keep this premium. We could have, however, ended up with a max loss of $5 minus 170 or 330. That could have easily gone the other way. We just don't know. Okay. So this one we said, well, if it makes a little bit of a pop, would be happy to collect a little bit of money. And this is one where they're not even going to buy anything back from you because it's so far out of the money, right? Here's our market price, 0.005. Okay, so we're just going to let it expire worthless at the closing bell today. The other trade that we did was a little bit more involved, and we needed the stock to move. And this one was more of what we call a diagonal, where we're trading different strike price and different time frames. So the strike price that we sold was this right here, December 12th for today. It was the 205 call that we sold short. We brought in a little bit of premium there of $1.50, and that helped offset the price of our longer dated 185 call. We had to pay $20 for that. So that one was a more expensive move. We couldn't have done that in the class, this class here. Just the short put vertical would have been ideal for this account size, okay? But it popped, and so we got out early today, early in the morning. We ended up closing that one for a pretty substantial gain. Right now it looks like price we got paid on it was $25.80. Okay, so we had our credit from the call that we sold, more than covering what the cost of that longer option was. And we just got out of our trade this morning. It was about, if you go through the math on that, I think it was plus $1,000 plus trade. All right. Now my time is up. Man, we've got to get out of here, you guys. Appreciate your attendance, your questions. You asked some really good questions here today. So we went through a couple new traits. We'll see what happens on those traits. I'll follow up on those in some of my other classes, all right? If you're following along with them, you can see them there. We put in those 2 new orders. We did a Merck trade, and we did an Adobe trade, which hasn't filled yet. I'll go back and make sure we get filled on that one. And we looked at what happened with Lululemon. All right, covered a lot of ground here. Thank you so much for your time and attention. If you'll do me the favor of filling out the survey, I'll love you forever. I'll also, if you found this useful today, hit the like button on the way out. Follow Mike and I on X. Pick up some little tidbits. Mike Sherborne CS, Connie Hill CS. And of course, make sure you're a subscriber to the network channel. All right, we'll see you right at the top of the hour. Cameron will be here with advanced charting techniques. We'll see you then. Bye-bye.